Welcome to our Taking Stock video for the week ending the 9th of June 2023. I'm Kien, Head of Research at Stock Doctor, and joining me today is our Equities Analyst, Daniel Ortisi, to stream to you all things share market. Great to have you on board, Dan, and it's good to see that you've been appearing more regularly now on AusBiz TV, where you really separate the facts from the noise.
Yeah, that's right, Ken, and it's great to be back on Taking Stock as well, and certainly a busy week to discuss for our members today.
Yes, and before we get started, just a reminder, the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Any shares, any tables and charts presented should not be relied upon as a guide for future performance. Well, Dan, it's been another big week for investors and mortgage holders, with the RBA deciding to lift the cash rate by another 25 basis points to 4.1%. And that was an unexpected move, given that the market had only priced in a 35% chance of a rate hike beforehand. And the hike was really driven by higher than expected inflation figures for April, which is sitting at an annualized rate of 6.8%. And this was further compounded by the Fair Work Commission deciding to increase award wages by 5.75% last week as well. And even building materials company Borrow, they stated that inflation is likely to stay high for at least another year, with price rises expected to rise for their building products.
That's right, Ken. And meanwhile, when we look at GDP data, which was released during the week, we could see that the economy slowed by only 0.2%. In the March quarter, this translated to a full-year growth of 2.3%. Despite this slowdown in growth, the hawkish tone from the RBA has prompted many economists to revise their terminal cash rate higher. As a result, the futures market are now increasing their bets, with the cash rate expected to move from 4.45% compared to a previous peak of 4.2% only a week earlier. Now, focusing from an investing standpoint, Kien, what does this really mean, and how should we be managing the portfolio when considering these conditions?
Yes, Dan, in our previous episodes, we did highlight some key points, but would like to reiterate them today. Firstly, when you've got slower economic growth and interest rate hikes, they will continue to put pressure on companies with weak balance sheets and vulnerable cash flows. Also, companies with low net profit margins are at significant risk as well. So focus on those financially healthy businesses that have a very strong market position and also defensive cash flows, so you can ride out this challenging period.
Yeah, furthermore, Kien, we also reiterate not to try and time the market. Recently, at the annual general meeting of Berkshire Hathaway, Warren Buffett argued that as a long-term investor, you have to be able to accept that the economy will go through both good and bad years. Your cash levels should be based on your risk profile and how much you want to allocate to equities. You may also have cash from profit taking. Now, this cash can help you act on opportunities when the volatility is quite high.
And of course, from a risk management standpoint, you want to maintain a well-diversified portfolio. Remember, rising inflation and interest rates will benefit some companies more than others. Think of gold stocks like Gold Road Resources and Alkane, which can act as an inflation hedge. Meanwhile, you've got beneficiaries of rising interest rates, including Net Wealth, Hub24, the insurers like AUB and Suncorp. Then you've got Challenger and Computershare there as well. And then, of course, there's also those defensive growth stocks which should outperform in this environment. These include healthcare stocks like CSL, Cochlear, ResMed, and even telcos like Telstra. And then there's consumer staples like Coles and Woolworths. They also provide that defensive cash flow as well.
That's exactly correct, Kien. And one also thing that we've noticed in the recent few weeks is that rising interest rates are really starting to put pressure on the retail sector. We have recently seen some earnings downgrades from the likes of Baby Bunting and Adairs, which are former Star stocks. Some of our current retail exposures include companies such as Lovisa, Premier Investments, Super Retail, Wesfarmers, and GUD Holdings. These stocks are expected to pay attractive dividend yields. We are currently running, a number of stress tests to see whether these companies can really sustain those dividends.
Yeah, our analyst team is monitoring the stocks in this sector because it is quite challenging for them at the moment. But given the slower economic growth numbers, we'd like to highlight a company that is quite tied to the economic cycle, and that's debt collection agency Credit Corp. The group did provide an update in May where management reaffirmed their financial year 23 earnings guidance for earnings to be about 4% lower on the prior period. But despite this, why has the share price fallen?
Yeah, well, Credit Corp's operating divisions, as you mentioned, Kien, are quite vulnerable to challenging economic conditions, and therefore the mounting cost of living pressures on consumers can play a part. For example, the debt collections division could be faced with lower collection rates or even default risks as customers are unable to meet their payment obligations. These risks are also transferable to Credit Corp's consumer lending division, which provides unsecured loans on higher interest rates. With these looming risks, Credit Corp may be faced with rising levels of bad debts that could convert into asset write-downs into the future.
Yeah, good points there, Dan. And with these heightened active risks, it's not surprising that Credit Corp is now trading at a rough 26% discount to consensus price targets. And given that these risks are driven by weakening macroeconomic conditions, any recovery to the health of consumers will take a while to pan out. So investors should be mindful of these risks before considering the stock as an opportunity.
That's right, Kien. And now moving over to the corporate calendar, it appears to be another quiet week on the Star stock front. We do anticipate that borderline Star growth stock Intertech pivot to go ex-dividend on next Thursday, with the gross dividend yield currently at about 8.5%. However, a reminder that this is not currently a Star income stock because these earnings are quite volatile and tied to ammonia prices, which can create some uncertainty with the forecast dividend yield. Furthermore, members can see this from the volatile history on the dividend payments on the 9 Golden Rules page.
And in Under the Microscope this week, we take a closer look at Australia's primary stock exchange operator, ASX Limited. The company flagged a new 5-year strategy to expand its technology modernization program. And this announcement was at odds with previous messaging that the company had already made substantial progress towards its technological transformation outside of its CHESS replacement program. And judging by the share price reaction earlier this week, the market was clearly disappointed about this update. So Dan, are you able to take us through the details?
Yeah, so for members who are new to the company, the ASX embarked on quite an ambitious plan to replace the current CHESS platform. Now, CHESS stands for Clearinghouse Electronic Sub-Register System, and it was introduced in 1994 to manage current share transactions and also record share holdings. Now, with the rise of cryptography over the last 5 years, the ASX wanted to replace the CHESS platform with an alternative based on the blockchain. The project, as some investors may remember, was dumped in November 2022, and the company took a $250 million impairment. Now we fast forward to this week's strategy day, where the market was surprised to discover that management intends to accelerate investment now into its technology modernization. This is set to see total cost growth spike with FY24 cost guidance of around 12 to 15%, well above current consensus expectations. Now, this higher expense has led to earnings downgrades over the short term for FY23 and FY24, potentially considering the impact into FY25 as well.
Yeah, and not only will this impact earnings, but management did also change their dividend policy to pay out between 80 to 90% of earnings, and that was down from 90%. Hence, this move also disappointed those income investors as well, Dan. And the gross dividend yield now is expected to be about 5.4% following the share price decline. So, given the earnings headwinds faced by the company, what are some of the factors that prompted us to retain the stock under coverage as both a Star Growth stock and Star Income stock?
Yeah, another great question, Kien. And one factor that really was at the front of mind was that the rapid re-rating of the share price, which appears to suggest that, many of these risks now appear to be factored in. The company remains, in a strong market position as Australia's primary share market operator, and this has helped it to sustain those really high net profit margins of around 49%, Kien.
And also remember, the company should continue to benefit from rising interest rates because it does earn income on client cash margin accounts as well. However, though, trend-sensitive investors should stay on the sidelines given that the stock has triggered an exit on the SD30 TSR in late 2022. With the uncertainty with slower economic growth, and many companies now trading at a discount to valuation, a useful question for investors this week is, how reliable are consensus price targets in the current market environment?
Yeah, that's right, Kien. And rather than take a discount to valuation at face value, it is really important for members to understand the reliability of these forecasts. Often, you'll find that the target price does revert to the share price rather than vice versa. To understand this relationship, you can view the history in Golden Rule 4. This often occurs when share price reacts to things such as earnings downgrades.
Yeah, very interesting chart there, Dan. And the other thing also, just be mindful that the number of analysts covering a stock also plays a significant role, as a lack of coverage can lead to greater uncertainty around earnings estimates. And this can be further compounded if the stock does lie in certain sectors like mining, where commodity prices heavily influence stock prices as well. So relying on price targets here may not be the best approach. In the current environment of slower economic growth, though, we would say it's safe to say that consensus price targets for companies with defensive earning streams are more reliable. And these are the stocks that lie in the healthcare, consumer staples, and utility space.
That's right, Kien, but it is crucial for investors to be aware of the current limitations of Golden Rule 5. For example, potential conflicts of interest within the industry can further undermine the reliability of price targets. Now, keep in mind that brokers may have incentives to provide favorable ratings to companies to strengthen their relationship with management and secure future deals. This is why you'll find typically more buy ratings on a stock than sell ratings.
Well, Dan, that's a concerning aspect, but it does highlight the importance of not solely relying on consensus price targets when evaluating a company's valuation. Rather, members should really consider our primary golden rules first: the financial health of the business, their past financial performance, the history of that, and the outlook and active risks before making a decision.
And also remember that a significant discount could be associated with really high active risks. Meanwhile, high quality companies with strong growth profiles, they often do trade at a premium to valuation.
That's right, Dan. A significant discount, especially if a stock is financially weak and has experienced earnings downgrades, often mean it is a value trap. And by understanding these limitations and considering a range of factors beyond consensus price targets, investors can really make more informed decisions. Well, that's all we have time for today, but thanks for your insights, Dan.
Yeah, it's a great episode, Ken. A lot of information there to unpack for our members this week.
And remember, you can tune into Dan on the AusBiz channel if you want to hear his views on markets and stocks. And if you have any questions with today's episode, feel free to participate in our Lincoln Live webinar, which is now on Tuesday due to the King's public holiday on Monday. And remember, with the end of financial year approaching, it may be a good time to introduce Stock Doctor to your family and friends so they can take advantage of the upcoming promotion. You can either do this by the Refer a Friend tab or send them a link to the free trial page. So to summarize today's episode, rising interest rate expectations mean risk management is a key in protecting your portfolio. Focus on those financially healthy businesses, remain diversified, and stay alert of how this active risk can impact stocks, such as those in the retail sector. And slower economic growth means that share price targets become increasingly unreliable. So put more emphasis on the facts, our 3 primary golden rules. Have a happy, healthy, and prosperous week, everyone.